Well, U.S. officials will meet this weekend with their Chinese counterparts in the first known talks between the two nations since widespread tariffs were announced. The meeting comes just after President Trump unveiled the trade deal framework with the U.K. Trump teasing, quote, many trade deals are in the hopper on Truth Social this Friday morning. But our next guest flagging 3 reasons not to get too excited about the prospect for more deals. Let's bring in Charles Myers. He's SIGNUM Global Advisors chairman and CEO. Charles, it's great to have you here. Just talk to me about the biggest thing to watch when it comes to these China deals, especially off the back of that UK framework. Does that make you a little bit more cautious about the likelihood of us getting some hyper optimistic deal with China that can make investors pretty optimistic on Monday?
Well, I think first, the White House has created, I think, an expectation that there may be some major breakthrough with China this weekend in the talks in Geneva. And I think, this is that we may get a few positive headlines on we're making some progress, but any deal with China is going to take months, if not even a year, to get done. I think the good news, though, and what's being discounted in the markets in a positive way, is that there has been progress on trade. I think the UK trade deal is certainly a sign of that. And I think that most of the news on trade incrementally from here is net positive. Again, it's going to take longer to get to some of these deals, but I think that the markets have been right to be a bit more optimistic on the direction of travel of the negotiations broadly and progress being made with several countries.
I'm interested in that, Charles, because we were just speaking with another guest who said maybe the market is already pricing in trade deals before we even get them. To what extent are you concerned that investors are trading on something that hasn't even happened yet and, to your point, could take a lot of time?
Yeah, look, I think that, the market sold off so aggressively on Liberation Day, and with the announcement, the president and the White House then had to do probably one of the biggest climb downs or U-turns within 13 hours of the tariffs going into effect, primarily because of the bond market. The Trump put is in the bond market. It's the 10-year and the 10-year yield. It's not in the equity market. But everyone went so bearish. And I think what was underestimated was, in fact, how serious this White House is, and Scott Bessent also is, at really making some progress on trade from here. So while it will take longer, perhaps, I still think the direction of travel is positive. And secondly, we can now pivot to the next big story in the markets, which is tax cuts and deregulation. I think people were just too bearish. I also think people were far too bearish on the risk of recession.
There's also the spin that we're going to hear from all countries that are negotiating deals. Who needs a deal more between the U.S. and China right now, from your analysis?
Well, I think the United States really needs it. The U.S. is on the back foot on this, given the amount that we import from China, with tariffs at 145% or 85%, wherever we land, even in the short term, is incredibly painful for the United States, both for inflation, for supply chain disruption, and for recession risk. So I would say that it's very much in the interest of this White House to get at least to get to de-escalation with China, if not working towards the framework of a deal.
If the U.S. is on the back foot, then, in terms of negotiations, you never want that, obviously. So why would China be incentivized to make a deal with the U.S. under the conditions you just laid out? And given those headwinds, can we expect to hear a lowered rate under that 145% level to come out of this weekend's talks?
Well, I think China, it's in both countries' interest to de-escalate and try to get to some kind of trade deal. I think where we ultimately land with China is probably somewhere between 20 and 30% tariffs. So not the 10% that will be universally applied to everything else coming into the U.S., but probably, somewhere between 20 and 30. I don't think that'll be announced this weekend. I think this weekend is about, really setting some ground rules and also a timetable for further negotiation. But it is very much in both country's interest to de-escalate this as soon as possible. And I think China's there. The issue with China, just quickly, is they're not afraid of the U.S., unlike some of the other countries that actually really are concerned and want to cut a deal quickly. China can play the long game, and they're not afraid. So again, tougher negotiation, but in both countries' interest to de-escalate.
Charles, I wonder how much this trade deal, if we see one come through, whether that be in the coming weeks, months, year, as you've even put on the table here, how much that just looks like the same phase 1, phase 2 trade deals that we saw in 2019 and 2020, where that essentially still had 25% tariffs on the table, and then $250 billion of Chinese imports, 7.5% tariffs on about $120 billion of Chinese imports.
Yeah, I think it'll look, some of the tariff level will look around the same. The improvement is that China will actually honor, as part of any upcoming trade deal, the terms of the phase one trade deal under Trump, which was to buy U.S. agriculture, machinery, et cetera, which they've reneged on. So I think that's an easy win as part of this broader negotiation. At the end of the day, Beijing has already signaled that their economy can absorb 20% tariffs from the U.S. Without, basically what they're doing with stimulus and other. I think we'll probably land between 20 and 30, so quite similar to phase one, but again, with China honoring the terms.
Charles, great to have you here with us today. Appreciate the breakdown and the analysis.
Thank you for having me.